Got made the chair.
I almost did.
Good afternoon, everyone. It is that time of the month. We're basically going over the numbers for the Monmouth and Ocean County sections of New Jersey. And I think everybody wants to know what the heck is going on in real estate. And we have most of the answers. I think we have most of the answers. I think it's going to be an interesting, I think for most people there's going to be an interesting topic about like where things are going based on the rates most recently, because I do think there is some headwinds here with this. FOMC obviously met this week. They're not going to be raising interest rates. They're on pause, so I think that's been confirmed. However, that seems to be temporary. So Chairman Powell has definitely looked at this and said they do expect another 0.25% increase in rates in the Fed fund rate. Now, like I said, the benchmark for mortgages is the 10-year treasuries, but the 10-year treasuries do get impacted somewhat by the fund Fed rate. So let's not forget that. So let's get into some of the data that's come in this month for the month of August. Obviously, we get the months prior. We don't have this month's numbers. We get them for the preceding month. And I think it's very, very interesting, to say the least, what the heck is going on here. But there are some things in reading charts that we could definitely, I'm going to get into a bit once we get into more detail. So let's begin our segment, because I have to go actually to the airport.
Yes.
I'm on a limited time frame here, but
yes, I'm going to do this a little bit
quicker than usual,
yes,
but comprehensive.
yes.
I'm probably maybe being a little bit more direct instead of Joe always says I talk too much. But so I over elaborate, and we're going to try to under elaborate a little bit.
All right.
But to all the people out there, let's get those numbers out there.
Yes.
So what do we got going on, Keri?
So we're going to start with the average days on the market.
Okay.
They have increased.
Yes.
Both year over year and month over month.
Okay. What are those increases?
So, month over month, it has increased 47%.
Mm-hmm.
Year over year, it has increased 36%.
And
now, why do you think that is?
Well, you know, at the end of the day, it all comes down to interest rates, guys. It's a low inventory, low volume market. We've said this before. I think for most people to understand, with low inventory, low volume market like we have, which is a highly unusual market. So this isn't kind of unprecedented in terms of like historical data. So we are at we've come up a bit. The absorption rate right now is at 2.1%. So it is up a bit. And anything substantial, because it's far better than here locally, but I think it's definitely New Jersey's Monmouth and Ocean County has been bucking the trend for the real estate market as a whole. So I think it's showing some healthy signs for sellers in a few different areas that have consistently improved. And I just see the consistent rise of prices in the Monmouth and Ocean County areas. But I'm going to say this because I think what happens is when you mix the data up a little bit, Monmouth and Ocean counties can be vastly different from the northern section of Monmouth County to the southern sections of the Ocean County area, which would include places as far down as Tom's River, right into like Forked River, all the way down to the Ocean County area goes almost all right into the Long Beach area.
Mm-hmm.
So Long Beach Island area. Not Long Island.
No,
It's the wrong state. But anyway, so why don't we get into what the? So we are up, but it's when you talk about historical numbers, you know, you're going from the average being maybe a month and a half to now maybe 2 months on the market. Is historically so low that it's not even it's incomprehensible, to be honest with you, to say that we're talking numbers that typically you wouldn't see in most, even in the most you would not say this is a dire market. There are some things though we will be getting into that maybe signaling things maybe slowing down a bit. So we'll get to that next question, Keri. What's going on with the next question?
What factors do you think are contributing to the decrease in months inventory?
Okay.
Like
Well,
fewer listings, increased sales.
I think what's happening is there is a decrease in inventory because people aren't putting their house on the market. So we look at the fact of one key factor is how many homes are actually coming on the market, how many new listings are actually coming on the market this year. Do we have that number? Do you have the number of actual houses that have come on the market?
The active listings?
Yes.
Yes, I do. I do have it.
You do have it.
So for August, it is about 3,200 listings, active listings on the
Okay.
market.
And then that compared to last year is what, 24?
Last year? Oh, wow.
Yeah, 24% down.
Yeah. Well, last month it's
Month over month is 24% down from
Yeah.
month over month, and for the year it's down
14%.
14%.
Yeah.
So the continued pressure, the downward pressure on inventory is definitely the factor in that. So people, they're in mortgages that are obviously not, they're not really feeling the urge to move based on the fact that they don't want to take on a higher interest rate if they in fact do move up, unless there's compelling reasons to do so. So it's not like a lifestyle move. These are people who essentially have to move for one reason or another, or it's a retirement situation, change your job, it's a divorce. It's like these are the types of reasons that like people would be more inclined to move. So if there's no other parameters at stake, people are just not ready to put their house on the market. There seems to be the continued downward pressure on inventory it's really another 14% down from a year ago. So we're consistently dealing with less and less inventory, and I don't see anything really happening to improve upon those numbers. We don't have that stat here, but I do believe beneficiary of this, to some degree, are home builders, which has also been relatively slow, and that's really what I want to just touch on just a little bit. Home builders are not inclined right now, based on the cost of building, to do as much construction, which is different from other very hot markets that have existed, even when the market was at its peak. New units are not coming on the market anywhere near like when 2006 and 2005, 2004, like when it really was a boom. So there's far less in the way of new construction actually hitting the market. So there's less development, and I think it's another that's putting even more pressure on the supply side. So you're not getting the supply of houses, and it's going to show up consequently in the average list price and the average. And there goes. Thankfully, we have mics on.
Yes.
We have. Probably could hear that. We have whole days. So what do you do? It's okay. We can deal with it. But anyway, let's get into the number. What is the average median sales price for August?
Average median sale price is up.
7.5%. Absolutely.
Over a month.
Month over month, it was a 7% increase. Now, it's important to note, it just continues. Now, that's not, you'll get that question, that's not typical of the,
It's like right next to us.
sorry guys, it's one of those things, it always got to happen now. There's always got to be something.
I know.
You know, it's like, and it has to be right at the door. But the landscapers come in and decide to landscape while we're doing this.
I know.
So much for the technical issues. Thankfully, we don't have much grace.
Yeah, right. He's leaving now.
He's leaving,
so.
and he'll blow away. What are those flies called? Those
lantern
flies.
Get them
We
out
get
of
a
here.
ton of them.
Yeah.
So anyway, the median sales price is up again. I have it here as 8% from month over 8%. Median sale price is up 8% in Monmouth and Ocean counties. But people are wondering what the heck is going on. I think.
Oh, I was looking at the wrong one.
Yeah, it's okay. I mean, so it's almost 8.5% month over month, and almost 4.4% on the year to date. So the acceleration, because of the continuing inventory strain, is definitely helping homeowners achieve a higher value. That is not what we're seeing here. So if you're from Staten Island, and typically in New York, our market isn't as robust as it is in Monmouth and Ocean counties. But I want to make this clear, folks, because this is Monmouth and Ocean encompasses a large, vast regional area for an MLS. This is not indicative of the entire region. So there'll be specific regions that we'll get into that question in a bit, but there's specific regions that will inflate this number quite a bit. So I think people should be really cognizant of that fact. So
Yeah.
yeah.
Are there any specific areas that are seeing more of a significant increase in listing prices than other areas in Monmouth and Ocean?
Yeah, I think one of the things is, again, there are some red hot places that just continue to see appreciation. And since the pandemic, everything pretty much north of the freehold area really has seen some growth in prices. Those prices have consistently outperformed the market. However, as you go further south of maybe freehold, the same parameters don't exist. So you're seeing a continued like great market conditions in like Red Bank, in places in the Red Bank area, in the Middletown area, in the Marlboro, Manalapan area. Middlesex County, we're covering Ocean, but Middlesex County includes Old Bridge, which is also, these places have seen the consistent inventory strain work in the seller's favor consistently. So, and people are adjusting their prices a little bit higher than what the average sale prices are going for. The increase in list price is up to people are increasing their list price by 11.86, almost 12%. So the average list price is up 12%. Month over month, year to date, it's 9%. So people are consistently, they're raising their prices about 4% over the average sale to list price. So people, I mean, it's a little out of range. But the one interesting thing is the absorption rate. Again, this is the month's inventory situation. That is up 17%. Now, you're going from, from like maybe 1.5 to 2.5 months of inventory. It's notable, but not worrisome for sellers yet. The real key question in the economy, so the Fed had a meeting, and one of the interesting things is is that they call it, there's a breaking point on what they call pre-pandemic savings. So there's a lot of people living beyond their means currently. So they have pre-pandemic savings that are being wiped away. So according to the St. Louis Fed chairperson, they expect at the end of September, most people who saved for the pandemic have spent out all their excess capital from the pandemic savings.
Really?
So this is where it gets dicey. And this is what the Fed has really paused itself on, because they want to see what this impact is. Because people have been able to sustain their way of life through excess savings that won't be available now. That's going to be a big question moving forward. How is that going to impact real estate? Are people using more money to pay for their loans? Are they using, because there's obviously other expenses involved, heating prices, gas prices. Gas prices have a more significant impact in New Jersey than they do here, because we're relatively close to things. But in New Jersey, you're going to put some mileage on your vehicle, and gas prices are going to have a huge impact. So, with that being said, we're going to look at like this savings rate, the post-pandemic savings rate is now basically at pre-pandemic levels, meaning that there is a lot of people do not have emergency savings, and you could check that out from the Fed. The Fed put out a statement about this. So that's what the pause really is indicative of. They want to see what that looks like in the coming months. How much is that going to impact defaults? Is it going to impact defaults? There are people who just, with the rate of inflation being what it is, people aren't having as easy a time making the bill. So we really have to watch that. That's something we're watching. So we'll take a look at that.
Interesting,
Yeah, it definitely is. It's really interesting to watch how this plays out.
Yeah.
Unusual situation though, overall. Very unusual times for real estate.
Now I want to get your opinion on pending sales being down 17% year over year.
Okay, so that is one of the things we are watching. Pending sales, which is houses that are going into contract, are down 17%. So it is while there's a lack of inventory, there's also a lack of sales happening. So weaker markets will suffer more. Now I've said this before. You guys in the Ocean County areas who are experiencing a little bit more of a slowdown than probably some parts of Monmouth County, especially toward the southern section. You are the tail of the whip situation. So like New York's market, a good majority of New York market moves into Monmouth and Ocean County. So where prices here will drop and fall very slowly compared to what I call the end of the whip, which is where this typical market would go, how far people would extend themselves geographically while still making like enough commute time to and from New York City. If in fact that's, it's less of a factor now, but it's still a factor. So what I call the tail of the whip is, I've said it before, it's like the whip. New York is at the beginning, so you don't have to shake it much for prices to change. At the end of the whip, though, where you go further away geographically, that whip swings further up and down. Price changes, positively and negatively, will happen much quicker in these areas than would typically happen in other areas located near major metropolitan centers, obviously. So it's something to pay attention to. It really is. So we're watching that because pending sales being down 17%. I mean, year over year, that's year over year. What's the year over year pending down? Year over year
is 17%. Month over month is 10%.
Okay, 10% month over month. So it's still it's a notable factor at those numbers. 17% is substantial enough to kind of like, let's take pause. Let's look at this because it's indicative that things are pretty a year-over-year 17% decrease by most standards is, but this market's so unusual, folks, that if that was a typical real estate market, if we were in a typical, like a historically traditional real estate market, that would be pretty darn substantial, a 17% decrease. On the downward pressure on prices based on inventory would probably be much more substantial, which is why we need to watch this carefully, especially if defaults start to head upward.
Mm-hmm. Now, how does the current inventory compare to the historical averages for Monmouth and Ocean?
So you are down basically, I mean, it's 20% year over year. It's basically, and if you take a historical look at it, I don't think the Monmouth and Ocean counties have had numbers this low probably in the last maybe 15, 18 years. So that's how little is out there. So that's what the unusual part about this is that it is so darn low. I mean, historically, it's unprecedented historically. You're not going to see that. Which is why it's such a strange real estate market, because when you see inventory levels so low and prices still on the acceleration side, you'd figure more people would be apt to move. Mm-hmm. But it's like, where do you go? And people probably extended themselves because it's just not as affordable to kind of pick up and leave as it was maybe 2 years ago. So people they're taking a pause now. They see that the cost of housing at 7.5% interest rate, almost 8 at one point, has a profound impact. And we're seeing that. We're seeing buyer activity has slowed substantially. You're going to see it in the next number, but I did notice something in the graph chart, that momentum, what I call market momentum. So we look at like how the price changes, and like when you get a peak to trough, if you know the charts, the peak to trough, charts that are coming out are showing that we may be at the tail end of a bump up in prices and activity. And this is where it gets interesting. I've said this many times, and everybody hates this term, but the dead cat bounce. Could it be the dead cat bounce? It happens in stocks. It happens in a lot of things. So like people assume that because it was so. We talked about this in the Monmouth Ocean County. For the first time in a while, the average list to sell price was over 100% for a very, very long time. Last October, November, rates went up around 7.2, 7.3, 7.4. Not as high as they were, but it was close. Those numbers came down to under. They dropped as much as 8% in a span of 3 months. So when we looked at February's numbers, we saw a very significant trend based on interest rates that the average list to sell prices were heading down. This year, December, January, February, rates came down quite a bit. They came down to just a bit under 6 at one point. I believe as soon as March, February, March, and activity was red hot again. So it is so interest rate dependent that, and I think that's where the Fed kept the rate. They bumped up the rates back in June, based on the fact that housing data was coming out that things were heating up very rapidly again, and the core inflation numbers is housing. So what they're looking at from the perspective of the Fed is it or isn't it a real bump up in inflation? We're going to continue to see the rise in inflation still take hold here. So it's really interesting to see if we kind of match the energy of what those numbers were last year at this time. See if it kind of draws back to under the 100%, which I believe it's at 100. Right, the average the sale to list price ratio is at 101.6. So that was I got it here. So this is out of August. So Yeah, and it fell back in January to 98, and that was at its low. 98.4, 98.3 in March. But remember, that's on the closed sale. So that you look at this as a 2-month factor here. So you want to draw it down. Like this is when the activity. So yes, this is more indicative of sales that maybe happened a month or two. The contract was a month or two prior at the height, because a lot of times New Jersey people have to wait for New York closings. So it does take about, and I mean, I love doing New Jersey because the closing is 30 days easy.
Yeah.
In New York, it could be as much as 4 months. It's like 3.5 months to close in a lot of instances. So, what does that mean? We're at 101. It's been holding at 101% of sales to list price ratio. That is not indicative of every area. We said this before. I don't think when you take the region itself and you say, well, you said it's up 100, 101. Yes, because in places like maybe, you go into the Manalapan area and the county surrounding Manalapan and Red Bank and Middletown, these places have buoys. So you may have maybe 103, 104 there, which is help buoying the number a little bit. So I want people to kind of like take pause and say we're generalizing an entire area. There are places that are substantially hotter than others, and you know, when you want the breakdown, obviously you're dealing with selling, and you could obviously contact us, and we'll get you a more accurate assessment as to what's going on to the specific area, how prices have moved. But that is a broad spectrum of area to kind of just put. But it's still, I mean, 101% of sale to list price ratio is still significant, regardless. I mean, it's a significant number, so it's definitely. I mean, it's very rare. This is 18 years for me. I've never seen this long of time where sales to list price ratio goes up over 100. But if you want the historical fact here, we got a little bit of recent history. Interest rates, when they came up last year at this time, that changed substantially. So I would take that into consideration right now. Well, I would be pretty certain that we're going to see that tail off in the next few months, just on the fact that interest rates have impacted what they impacted last year at this time, and it's even a little bit higher this time. Those sales to list price ratios are going to take a hit. There's no doubt about it. And based on the forward-leaning charts that I've read, the sales to list price ratio, there's a peak to trough situation happening here. So we kind of, the funny thing is that if you read stock charts, and I'm familiar with stock charts as well as it has a dead cat bounce look. It has a very, very high peak, a very deep dip through from basically last July through this till January, and then hitting bottom. But so what happens is what we call, if you look at charts, it has a head and shoulders approach to the appearance. Head and shoulders approach is that you get a peak, drop, you get a little bump up again, and then you start seeing things tail down. I do think we're going to see that tail down now based on just a fundamental chart reading that I'm looking at. So I look at it and I say to myself, okay, we hit a peak at almost 104% in 2022 last year, which is what was at the absolute peak. We started to come up on that peak back in this July at about 102, but we didn't break the 104. So you would look at that as a momentum factor, and the momentum looks like it's petered out. So we're on the downslope from July to August. So it came down a bit from the July numbers. So the momentum is definitely swung back, looking like there's some downward pressure here. Just based on chart readings, And I do believe that market momentum does follow these kinds of charts to a certain degree. But we'll see. I mean, it seems to be the chart that I'm looking at. So.
Interesting.
Yeah.
All right. So I want to know what you think the current trends right now. What are the projections for the Monmouth and Ocean estate market in the next 6 to 12 months, you think?
Okay, so this is, I would have some, you have to have some experience working here for you, because I do think at the end of the day, somebody said to me at the end of the day, I use that term a lot, at the end of the day.
Yeah.
Well, to make my point clearer, let's say, I would like to tell you that you would need to really consider people's market knowledge about how these trends play out for you if you're in fact going on the market. Doing the wrong type of thing in these markets could be pretty bad. So, and I've seen it, and this is why timing markets based on market, what you hear about the market. Oh, my neighbor sold for this. You don't get the macro data that supports a conclusion. I would be very, very, very cautious about what you're hearing, because, how do you say, people use no matter what it is you do, whether it's real estate or anything else, they use the most extreme example as the barometer for like what's going to, someone just sold for 40,000 over list. Based on that, this is what I think we should do. That's a lack of trust in the process. I mean, because it's like you're using a sample size of 1, which is not a way to sample size anything. Yeah. It's not a good sample size to say, 1, and the market conditions, I can tell you this, are highly volatile with interest rates being as high as they are. It's a more volatile situation with housing prices based on interest rates. So, I will tell you this. For the next 6 months, what you're going to see is there's going to be a pendulum swing backward. Now, we're going to look at employment data, see what's going on there, because I think that's what the Fed is really waiting to see what the savings rate that's now been exhausted by most Americans, according to them, who had pre-pandemic savings, will exhaust them. Where that leaves the general economy, credit card debt is at an all-time high. It broke the 1 trillion mark last month. We have a heck of a lot of debt out there. The Fed's going to have to watch. This is a critical juncture here. It could be a day of reckoning for a lot of things if they get this wrong. So you could wreck a lot of people quickly with rates being what they are. It's such a system shock to a lot of people and a lot of households. And I've said this before, I say it again, it's what I call, governing from the penthouse. The street level stuff that goes on is different from what's like how the policy is being geared towards. So we deal with it a lot. And, there's been more distress situations that I've seen recently that I haven't seen in the last 6-8 months. Distress will play a role. In the next 6 months, we're going to see what the financial stress of everyday Americans is and how it's going to play out in these next 6 months. Because if people start going behind on things, does it create a rise in defaults? The U.S. Treasury nor everyday people are going to really they're going to factor in how profound this impact could be for them, especially people who are without savings. I mean, it's a little scary to be, if you're running a household and you have, you just don't have the savings. And that seems to be a thing that happens more and more. Okay, I gotta sell my house to pay the food bill. It's my tax bill's up and I need to pay the tax bill. And How many of these things fall into arrears and then begin the process of possibly foreclosing? I'm not convinced of that. But unfortunately, one of the things about real estate, and I'll say it, quickly, most people wait for the wrong time to do everything in real estate. So they usually, if you are in the process of distress and you're feeling distressed, my thing is people, they rely a lot more on hope than the realities of playing the cards correctly. So what happens is they'll wait for, the defaults to rise, and they'll say, oh, well, I can't afford it, now it's time to do it. And now they're in a worse situation. If you're experienced and you think that your 6-month projection doesn't look good, personally, you should be doing things proactively, not reactively. Because if it does go in the wrong direction, house prices, now you're going to lose money on any equity positions on your house if it goes in another direction. There's people who are still projecting that the housing market's going to increase. I don't believe, based on the numbers here, that that's going to happen. I think the last straw in this camel's back is the employment data. It's good. Yeah, employment data is going to be, I'm going to say it again, they're really pushing for unemployment. I mean, that's the purpose of the higher interest rates. They are trying to drive they're not going to say it that way, but they're trying to drive Americans out of work. Because without income, what are you going to do? You're going to drop prices. Because there's no competing, people without money can't compete in the marketplace, so what happens is the marketplace becomes cheaper. And that's the play here. But housing is screwed up for a multitude of reasons. I'm not going to get into every one of them, but I definitely think that subsidies have kind of hurt the market as far as affordability is concerned, just like college tuition. And I think that's but that's a debate for another day. You can't subsidize and then charge more based on the fact that, so you look at the rental markets, you look at those things, they're artificially propped up because it's not truly people who are in the market for, they're getting subsidized money that they would not be earning, and they're competing against people who are earning. So you're driving the prices up on rentals, not based on a market rate, but on an artificial number that, so you deal with this all the time, but, it's not a market system, and then what happens is you get these unequal balances to things. So I definitely think that, to a large degree, it's nice to help. I think it's long term, to compete with working people on the housing is probably one of the biggest constraints to the marketplace right now. So I think that's, whether you're trying to help or hurt, I mean, it's not, there's definitely some things here, but I mean, that's for another day.
Yeah.
That's for another day to show. But the 6 to 8 month projection is, I'm not going to put a stamp on anything per se, but I will tell you this: it's going to be a challenging real estate environment for a period of time. Most people are going to miss the bounce, because when this turns around, the peak to trough, everybody does things based on information that's always 3 to 4 months old. Mm-hmm. And, it's the people who catch the bounce. Some people did this time. They catch a bounce, the rates drop to 5.99. All of a sudden, houses again start accelerating in price. But people who kind of said, oh, we're going to wait this out, they missed, we're on the tail end of that again. So they kind of miss out on it. Guys, timing this out is never the best idea to begin with, but it's something the smartest brokers and agents are going to know exactly what I'm talking about. If you don't know these numbers, and you can't read a chart, or you can't predict what's going to happen, assuming things are going to happen is rather oversimplifying things. And I don't think people should oversimplify with this. With the very, very intricate pieces this market's kind of presenting itself, can change very rapidly, and the market's far more volatile than it's been in years. So it's something you have to consider. I think experience does know that, you know, to a large degree, and that's why we don't run the largest operation, because we don't let people fly off the rails and not know the data that's going to be helping their potential clients know what they should be doing in this market. So I don't like to fudge people over with the idea that things are better than they are. It's not productive for them, and it's not productive to the process. But there'll be some tough situations in the next few months that may be a little bit more tougher than people want to take. But I don't think, and I'm not going to throw water on this market, these numbers are ridiculous. So if you're selling, this is premium territory. So anybody who's thinking like, oh, I'm going to wait for the prices to go up further, I think it's silly at this point. It's just, I don't think it's good. If those interest rates come down, folks, I keep saying this, I'm going to say it again, I'm going to repeat it 1,000 times. Move up buyers, this is the time to move up, period. The top end of the market, if a market slowdown occurs, happens quicker at the lower end of the market. Not when things get better. So please, you can't buy into the rhetoric that, oh, well, prices are going up. Now is the time to sell, to move up. No, it's not. It's actually when prices are going down, move up buyers will have the best advantage, because at the top end of the market always slows down ahead of more affordable. That's the way it works. People try to play this game. It's like, oh, well, I made an extra 10%, the market went up, and the place that I'm going to when the market accelerates is, it drives up the price 12%. Or 10% of a bigger house is going to be much more substantial number than otherwise if you did it during a downward sloping market. But we're not, there's nothing here that says we are in it. So this is more predictory. I don't think that prices should change too much, with the one last piece being what this does with the economy in the next 6 months, the interest rates. That's how we're going to leave it.
Yeah.
That's it.
That's
my prediction.
Yeah? Okay.
Was it a prediction? Or was it I don't think I sewed up any.
No.
I'm sure. It was like, is it going up or going down? Just give it a straight answer. No, I'm not going to tell you that. Because there's too many nuances to this to say, and I'd rather be about data stats, about anything related to real estate. Contact us here at Prodigy. We'd love to hear from you.
Yes,
okay?
Please.
Thank you, Keri.
Yeah, thank you, Anthony, for all the information.
All right.
And insight. All right.
Yeah, she's giggly today. Have a great day, folks.
Yes. Bye, guys.